Good afternoon. It's Jeff Christian from CPM Group. It's actually Thursday, the 23rd of September, a little after 4 o'clock in the afternoon. I'm recording this Thursday because I'm going to be out of the office Friday working. I wanted to talk today about the market outlook. Relatively short presentation, no special type of things. I was thinking about putting some stuff in that I'm going to be using at the Silver Symposium next Monday and Tuesday, but I haven't gotten all of the research done to really put it in there. And I think that given the fact that the gold price dropped $27 today and silver fell very sharply too, that I should probably just focus on the market outlook as we see it right now. The title here is "The Bull Market is Not Over." And I put that up there because, quite frankly, we have been having a lot of people ask us, hey, is the bull market over? We saw prices in the case of gold, bottom moving sideways 2016, 2017. I mean, the bottom was in at the end of 2016. Prices started to rise a little bit 17, 18, into 19. They rose very sharply. They peaked at a little over $2,000 in the first week of August 2020. They fell very sharply into the first quarter, and they've basically been moving sideways largely between, say, 1740 and 1900 ever since then. A couple spikes down to 1680 or 1640, whatever they were, but basically moving sideways. And silver prices, well, they were even more pathetic from 2016 to 2019 and 2020. They dropped off at the beginning of 2020, and then they rose very sharply into the first week of August. And they've moved sideways. They haven't given up as much ghost as the gold price has, but they haven't made new targets. And that, for the people who really want to believe in silver, they thought that the price would be 30 or 50 or 100 or $1,500 by now. And, it's 22 something today. But the price of silver actually has held up much better than gold. I'll come back to these charts in a second, but let me just show you one other chart just to put all of this in perspective. This is the price of gold since it was freed to float in 1968. Price reached record prices last year. This is only through February, so it doesn't necessarily show what all we've been doing. The price is still very high. And for people who complain that the price isn't high enough, they really don't have a proper perspective as to what gold as a monetary asset, a financial instrument, and a commodity is. But that's what makes them gold bugs. I look at the gold market and I look at the silver market. And as I described in past videos, our projections are based on both a macroeconomic top-down view. This is where we see the world, where we see China, the United States, Europe, and other major components of the world, economically, politically, and in terms of financial markets. And we meld that with a microeconomic bottom-up view of each market: gold and silver, manganese, copper, aluminum, nickel, platinum group metals. Our view of where the market is going is based on our view of the world, where it's going, and how each industry sees it. We look at gold. Yes, it's risen very sharply since 2016 into last year, and it's come off a little bit. We see the current weak prices, if you want to call them that, as a consolidation phase. Between the first leg of the price increase from 2016, 2017, we probably use 1200 as the base, but some people would say no, it was 1064, whatever. We see that as the first leg of a bull market, which we've discussed really since about 2010, when we've been talking about how the price would come off for 5 years or so, 3 to 5 years after peaking in 2011. Price would come off for 3 to 5 years, and then it would consolidate and start to rise, and probably rise to new record levels. That's been our view really since before 2010, but let's be nice. We see the current price period as a consolidation between legs of the upward bull market. The first leg, 2016, 2017 to 2020, consolidation now, and then another leg up later. Our expectation is the consolidation will last for probably 5 quarters, maybe longer. It's going to depend on how the economy and the political environment shake out, both on an international basis and within the United States, China, and other major economies/nations. Our expectation is that the real economic recovery will continue and will move into an expansion, and that will distract some investors from gold and silver. Inflation, we have been saying that we agree with mainstream economists and the Fed that most of what we've seen in inflationary pressures are transitory. If you look at the August CPI, yes, headline inflation was up 5.3% from August of 2020, and core inflation, ex food and energy, was up 4%. But if you look at August relative to July, the only component of the CPI that was up more than 2% was petroleum-based energy, and it was up 2%. That compares to 35, 40, 45% increases in petroleum-based energy price increases in the previous 3 months. Autos, used autos, which also was the other big component, rising 40, 45% in previous months, actually was down about 1.5%. All of the other components of inflation in August relative to where prices were in July were up less than 2%. That suggests that A, you've got some transitory issues going on, and B, you probably shouldn't be measuring August inflation compared to where price levels were in August of 2020, because that gives you this big increase, most of which has already been in the market and in the economy as of July. But you should look at what's happening in August relative to where we were in April, May, June, July. And August's data on a monthly basis suggests a lot of transitory nature in inflation. Interestingly, the Fed in its FOMC meetings this week basically agreed with that, and they lived the adage that I used a few weeks ago, William McChesney Martin saying, the purpose of the Fed is to lean into the breeze of inflation, to raise interest rates and tighten monetary policy at the first hints of inflation, not to wait until inflation gets worse. The markets clearly understood this morning, today. Stock market is up sharply. The bond market is actually off a little bit, 10-year bonds day to day. The dollar fell against the pound and the euro, but it rose against the yen. And gold and silver and other commodities fell off. So the broader financial markets are saying, okay, the Fed is acting to make sure that we don't have a systematic problem with inflation, that inflation will be kept under control. Interest rates will remain low. They're starting to rise, and they're going to rise further, the Fed said. But if you look at the dot plots, they expect interest rates to rise up to about 2% by 2023 from 1.3%, well, from 25 bips now at present, and to maybe 2.5% in the long run. That's in a world of 2% inflation, 2.5% inflation. So you're still looking at real inflation adjusted interest rates of 0 to maybe 0.5. That's not the kind of real return that's going to cause people to say, I don't need to buy gold and silver because I can get 0.5% inflation adjusted returns on treasury bills. It's not going to happen, right? So interest rates are likely to remain low from a historical perspective for the next decade, according to the Fed, and that actually jives with our views. They've been low for the last 13 years, so we're halfway through this period of extremely low interest rates. Inflation's not a problem. The dollar's not collapsing, and equity markets are dusting themselves off based on the idea that the real economy is going to pick up. In that kind of environment, we would expect gold prices to trade broadly between 1740, they almost touched that today at 1751, and say 1900 for the next quarter or so. and that over the next 5 quarters, maybe they trade between 1740 and 2000. Upward pressure is there, but not so keen as to drive the price sharply higher. That may change, but we don't think it's going to change until, say, 2023. But again, that depends on what happens in the real economy and the political environment. Silver's been stronger than gold, and we expect silver to continue to be somewhat stronger than gold. But quite frankly, for the next quarter and the next 5 quarters, we think that the silver market probably be well contained between $22 and $28 or $29 on the upside. Could see some spikes higher later in 2022, especially around the time of the by-elections in the United States. But we don't see silver prices running away in the next several quarters. Again, 2023, 2025, we expect to see much higher gold and silver prices, record levels for both of them. So that's sort of where we are. And that's what we expect. And that's what we've seen over the last week or so has basically confirmed that. Again, put it into perspective, gold prices are at record levels. I'll be at the Silver Symposium next Sunday, Monday, Tuesday. I'm giving a speech on silver, tentatively set at 11 a.m. on Monday. I'll be around for an expert meet and greet Monday night. I'm doing the Challenger Assumptions Open Q&A period at lunchtime on Tuesday, and I'm doing a workshop on how to invest in gold and silver in a world that is not collapsing on Tuesday afternoon. You're welcome to join us there. If you can't make it there, you can continue to watch our videos. You can buy our yearbooks to get a lot of information. If you're a retail investor, we have retail investor programs, open forums, and you can learn about more things that we're doing for people and corporations and governments in an introduction to CPM Group. Thank you, and I'll talk to you next week.